Hello and welcome to the Commodities Institute podcast. I am your host, Emily Costa. It is Tuesday, March 31st, 26, and we are witnessing one of the most volatile periods in global trade history. From the high-tech smelters of the Middle East to the coffee plantations of the Highlands, the map of global commerce is being redrawn in real time. We begin today in the metals market, where the landscape shifted violently over the weekend. For months, the primary concern for aluminum was simply getting the metal through the Strait of Hormuz. But on Saturday, the risk moved from shipping to actual production. Iran significant attacks on two of the world's largest aluminum smelters, the Al Tawila site in Abu Dhabi and the main plant in Bahrain. Together, these facilities represent a massive 3.1 million metric tons of annual capacity. To put that in perspective, the United States produced just 660,000 tons of primary aluminum in all of 2025. The impact was immediate, with London Metal Exchange prices leaping 6% on Monday to nearly $3,500 a ton. This is a strategic nightmare for the United States, which relies on imports for 60% of its aluminum needs. While some analysts suggest the US military gets its supply primarily from Canada, the broader industrial base in the US is now facing a supply vacuum that simply cannot be filled overnight. While aluminum is making headlines for its scarcity, lead is telling a completely different and quite fascinating story. Lead has long been the unloved sibling of the battery world, overshadowed by the lithium-ion revolution. But right now, lead is behaving more like a financial bond than a metal. Because there is such a massive oversupply, with inventory in Singapore hitting 14-year highs, a steep contango has developed in the market. This means the price for delivery in the future is much higher than the price today. Savvy investors and banks are buying the metal now and selling it for a year from now, locking in a nearly 7% return. It has become a metallic revolving door in Singapore's warehouses, serving as a particularly attractive vehicle for Sharia-compliant investors who avoid traditional interest-bearing instruments. It is a brilliant example of how commodity markets adapt even when the underlying material is in a long-term structural decline. Moving from metals to energy, the crisis in the Middle East has sent shockwaves through the liquefied natural gas market. Qatar, usually the bedrock of global supply, has declared force majeure, shutting in facilities that account for 20% of the entire world's LNG supply. This has left a massive hole that other producers are racing to fill. In Texas, we saw a major milestone as the Golden Pass LNG project, a joint venture between Qatar Energy and ExxonMobil, produced its first gas. While this is a beacon of hope for global supply, it comes as Australia, now the world's second largest supplier, faces its own internal battle. Gas majors like Shell and Chevron are vocally warning the Australian government against imposing a windfall tax on LNG exports. Canberra is looking to capitalise on surging prices to help the domestic budget, but the industry warns that a tax exceeding 25% would kill future investment and render Australia uncompetitive just when the world needs its gas the most. The ripple effects of this energy crisis are also being felt deeply in the agricultural sector. India, which relies heavily on the Gulf for its fertilizers, is moving aggressively to diversify. Prior to the war in Iran, the Gulf provided up to 30% of India's urea and phosphate imports. Now, New Delhi is signing long-term deals with everyone from Russia and Morocco to Jordan and Togo to ensure their summer-sown crops have what they need. They are even rerouting shipments from Russia around the Cape of Good Hope to avoid the chaos in the Middle East. It is a massive logistical pivot that shows just how high the stakes are for food security. Speaking of food security, a sobering new report from Rabobank has highlighted a long-term threat to one of our favourite daily staples, coffee. The report suggests that by the year 2050, 1/5 of the current areas used to grow Arabica coffee will be unsuitable due to climate change. We are talking about major producers like Brazil, Colombia, and Honduras. While Ethiopia might actually see its suitable growing land increase, the overall volatility in rainfall and temperature is making the coffee market increasingly unpredictable. For high-yield areas in Brazil, the move from suitable to marginal land could mean a significant drop in output, which inevitably means higher prices and more supply shocks for the consumer. Now, we cannot talk about commodities today without addressing the oil market, which has reached a boiling point. The Dubai oil benchmark hit an all-time high of nearly $170 a barrel last week, shattering the previous record set back in 2008. With the Strait of Hormuz effectively closed, 10 million barrels of oil per day, that is 10% of global consumption, has been knocked out of the market. This has created a fierce bidding war. Asian buyers are so desperate for barrels that they are outbidding European refineries for oil from West Africa and even the North Sea. We are seeing tankers of diesel that were originally headed for Europe making U-turns in the middle of the ocean to head towards Southeast Asia instead. In the midst of this, China is playing a very careful and somewhat cold-hearted hand. While its neighbours in Southeast Asia are begging for fuel and fertilizer exports to be resumed, Beijing is keeping the gates firmly shut. They are focusing on their own domestic economy, stockpiling reserves that they have been building for over 20 years. Analysts say China has no desire to be the region's energy backstop during this disruption. They are sticking to a tried-and-true playbook. Protect the home front first, and only resume exports once they are absolutely certain their own energy lifeline is secure. Finally, a quick look at the freight and bulk markets. Russian wheat exports have remained remarkably stable despite the geopolitical headwinds, with analysts actually raising their export forecasts for the month. The weather has been favourable and the winter crops are in good condition. Meanwhile, in the cocoa market, arrivals at ports in the Ivory Coast have seen a sudden surge. This isn't because of a bumper crop, but rather a regulatory move. Authorities brought the mid-crop season forward by a month, which triggered farmers to release beans they had been holding back. While arrivals are still down slightly year on year, the sudden influx of over 100,000 tonnes in March has eased some of the immediate concerns about a supply squeeze. It is a world of incredible complexity and high-stakes manoeuvring, whether it is the tactical strikes on aluminum plants or the slow-moving threat of climate change on coffee. Every piece of data tells a story of a global system under immense pressure. Thank you for joining me for this deep dive into the markets. If you found this episode valuable, be sure to subscribe, share, and leave a review.